Welcome to the deep dive. Today, we're going to unlock the secrets of your financials,
Hmm.
really getting into management accounts.
Yeah.
Forget those dusty spreadsheets, the year-end dread. These aren't just numbers for accountants.
No, not at all.
They're more like the ongoing story of your business. Performance, health, unfolding, like in real time.
Precisely. And our mission here really is to give you these new lenses to show you how these internal reports, well, they're your best tool for timely, relevant info.
Okay, internal, that's key.
Exactly. Unlike, say, annual accounts, those are historical snapshots, mostly for tax. Management accounts, you prepare them much more often, monthly, quarterly sometimes.
For proactive insights.
That's the goal, proactive decisions.
I like that. Lenses. So if we're putting on these financial glasses, what are we looking through first? What are these core statements?
Okay, yeah. So a typical pack has 3 key statements. Each gives you a different view.
Yeah.
Think of the profit and loss, the P&L. That's like your video camera.
Yeah.
It records performance over a set time.
A specific period.
Yes. Then the balance sheet. That's more like an X-ray, a snapshot of your financial structure, underlying health.
At one moment in time.
At a single point in time, exactly. And finally, the cash flow statement. That's the vital signs monitor, maybe, showing where the actual money is moving, the blood flow.
That's a brilliant way to put it. Okay, let's start with the video camera then, the P&L, profit and loss. Where do you even begin with this one? Why look at it over a period?
Great question. The P&L, well, it cuts right to the chase. It answers that fundamental thing. Are we making money?
Okay.
And tracking it over a period of month, a quarter lets you spot trends. You start right at the top line, revenue or sales, turnover, whatever you call it.
Is it growing, shrinking, flat?
Exactly. That's the first check, but, that's just the beginning.
Right, because sales don't automatically mean profit. What's next down the P&L?
Precisely. After revenue, you subtract your cost of goods sold, COGS. These are the direct costs.
Materials, direct labor, that sort of
Yeah.
thing?
Yeah, things directly tied to making what you sell, what's left. That's your gross profit.
Okay.
And this number's huge. It tells you about the profitability of your actual core product or service.
And the margin. You mentioned margin.
Yes, the gross profit margin. That's your gross profit divided by revenue times 100. If that percentage is unexpectedly low, big red flag.
Meaning?
Meaning you either need to look hard at your pricing or really dig into how efficient your production is.
Makes sense.
After that, you take out operating expenses, your overheads, rent, salaries, marketing.
The day-to-day running costs.
Right. That leaves you with operating profit, sometimes called EBITDA. It shows how efficient your whole business operation is.
Okay.
Then finally, after interest, taxes, you get to net profit, the famous bottom line for that period.
Got it. So P&L is the video, performance over time. Now the X-ray, the balance sheet. What does that snapshot tell us about financial health right now and this equation? Assets, liabilities, plus equity.
The balance sheet is that snapshot. And that equation, assets, liabilities, plus equity, that's basically the whole framework. You have to balance.
Okay.
Assets are just what your company owns. Think current assets, things easily turned into cash within a year.
Like cash in the bank or invoices customers owe you, accounts receivable.
Exactly. And then fixed assets. These are your long-term things. Property, equipment, machinery, stuff that lasts.
Right. And liabilities.
Liabilities are what the company owes. Again, you have current liabilities, debts due within 1 year, like bills from suppliers, short-term loans.
Accounts payable.
Yes. And then long-term liabilities. Debts due further out.
Okay, so assets own, liabilities owe. What about equity? What's that?
Equity, well, it's the residual value. What's left for the owners if you sold all the assets and paid off all the liabilities?
So the net worth of the business, kind of?
Essentially, yes.
Yeah.
A growing equity figure. That's often a really good sign. Shows profit is being kept or put back into the business. Vital for long-term health.
And you mentioned ratios here.
Yeah, we look at things like working capital, current assets minus current liabilities. Shows if you can cover immediate debts. And the current ratio.
Which is?
Current assets divided by current liabilities. Gives you a quick check on liquidity.
Yeah.
Generally, something between 1.5 and 2 is often seen as pretty healthy.
And below 1 is a worry?
Below 1 can be a warning sign, yeah.
Yeah.
Might signal trouble paying upcoming bills.
Okay, profit checked, financial position X-rayed. But there's that crucial bit, the actual cash. That saying, profit is opinion, cash is fact. Why does the cash flow statement matter so much?
Oh, it absolutely rings true. You wouldn't believe how many profitable businesses on paper have failed because they just ran out of cash.
Really? Wow.
Yeah, so the cash flow statement, our blood flow analogy, it tracks how cash actually moves in and out, not just invoices sent or bills received, real money.
So it's not about profit recognition rules, it's about the actual bank balance changing.
Exactly. It's broken down into three main parts.
Okay, what are they?
First, cash from operating activities. This is the cash from your main business, selling your product, providing your service. Ideally, this needs to be positive.
Makes sense. The core business should generate cash.
Right. Second, cash from investing activities. This tracks cash spent on or received from selling long-term assets, buying new machinery, selling old property.
Okay.
And third, cash from financing activities. This is cash related to debt and equity, money from investors, bank loans coming in, or loan repayments and dividends going out.
Gotcha.
And looking at all three together shows you the net change in your cash over the period, plus your opening and closing cash balances. It can instantly show if, say, you're profitable, but your customers aren't paying fast enough.
Or spending maybe too much on new equipment right now.
Precisely. It connects the dots.
So let's bring this all together. What does this really mean for you listening right now? Why learn to read these?
Well, it means you can stop just reacting to problems after they happen. By regularly looking at these three statements, you start to understand your business's story as it unfolds. You see what's working, you spot trouble early.
And you can actually fix things.
Yes, and make informed, data-driven decisions. It really shifts you into being a proactive owner or manager.
Exactly. So don't wait for that big year-end report to suddenly find out how things went 12 months ago.
No, please don't.
This knowledge, used regularly, helps you build a healthier business, more resilient, and ultimately more profitable. So here's something to think about. What story are your numbers trying to tell you right now? What stands out to you from today's deep dive?